Hey YouTube, I'm Jimmy. In this video, I'm going to walk through creating a high dividend ETF portfolio. This video builds on our last video where we looked at building a long-term dividend ETF portfolio. The primary difference is that in this video, we're going to have higher dividends. Now, just like the other two ETF portfolios that we created, our goal in building this dividend ETF portfolio is to focus on ETFs that have high quality companies, lots of diversification, and obviously a very good yield. So in our last video, we focused on portfolio stability. We target a reasonable yield. We had about a 3.5% dividend yield. But in this video, we're going after 6%. So we're going to get a bit more aggressive about it. Sure, we're going to have to pay a higher fee for many of the ETFs since they're going to be specialized ETFs, but allowing for more fees gives us more options when it comes to the ETF space. And just like our last video, we're going to turn this portfolio into a satellite portfolio. And basically what that is you have a core set of holdings and then you have individual holdings that in theory complement a particular objective of the portfolio. So maybe you want to add more diversification, or you want to add exposure to a particular sector, or more growth, or more value, or more dividends, or whatever it might be. That will depend on what each of us individually want to do with our portfolio. Okay, let's get started. So we're going to call this portfolio our monthly high dividend yield ETF portfolio. It's going to contain 5 ETFs, all that pay monthly dividends. Once again, our goal is to create a core set of holdings, and then we'll talk about customizable satellite positions. So our first core high dividend ETF is the Invesco S&P 500 High Dividend Low Volatility ETF, ticker symbol SPHD. SPHD has a fee of 30 basis points. They have about 50 holdings, and they have a dividend yield of about 4%. And just so we're all on the same page, for each of these ETFs, to calculate the dividend, what I did is I took the last 12 months of dividends paid and used those, added those up, and divided by the current price. And that gives us the dividend yield. Okay, easy enough. So SPHD goes after the less volatile, large and mid-cap names picked from the S&P 500's 75 highest dividend yielding stocks. So the whole ETF ends up looking a lot like the market does. They have companies like HCP, AT&T, Verizon, Procter & Gamble, companies like that. But what I like about this ETF is that they have a lot of traditionally defensive industries like utilities and basic materials, and less of the more volatile industries like consumer cyclical and technology. So I like this as our first holding, and it will act as sort of a core holding on some of our more volatile holdings going forward. And just like we did in the other videos, we're going to save the weightings until the end of the video. Okay, so for our next holding, we have the high yield ETF, ticker symbol HYLD. HYLD is the only bond ETF in our portfolio. They have a fee of 118 basis points, and they have over 100 different holdings. Their fee is a bit high, but it makes a lot of sense because this is an actively managed ETF, and that requires portfolio managers that can do credit and valuation analysis on the corporate bond holdings. They have a dividend yield of almost 8%, and generally they invest in non-investment grade bonds. Those companies tend to be smaller, which therefore gives us more high yield opportunities, but a bit more risk. So HYLD gives us our bond exposure. Okay, so our next holding is the Global X SuperDividend US ETF, ticker symbol DIV. DIV has a fee of about 45 basis points. They hold about 47 different companies, and they have a dividend yield of about 6.5%. And just like our first ETF, well, this ETF looks at low volatility names, a bit smaller than the first one, but they get a bit more yield. They are also well spread out. They're mostly in utilities and financials. They have consumer staples, they have some energy, some communication services, some real estate, some healthcare. So they are well spread out ETF, but they tend to focus on slightly smaller companies. So I think it's a nice complement to our first two ETFs. So for our next holding, we have the Wisdom Tree US MidCap Dividend ETF, ticker symbol DON. DON has a fee of 38 basis points. They have about 400 holdings and slightly more than a 2% dividend yield. More than half their holdings are in consumer discretionary, real estate, and industrials. They own companies like L Brands, Kohl's, Tapestry, Macy's, Targa Resources, and because this ETF focuses on consumer discretionary companies, Well, I think that this ETF offers some growth opportunities that the other ETFs don't have. So I believe that this is a good complement to our portfolio because this gives us a bit of growth opportunities in addition to a 2% dividend yield. Okay, now into our last core holding. For that holding, we're looking at the Invesco KBW High Dividend Yield Financial ETF, ticker symbol KBWD. Now, they have a crazy high fee of about 240 basis points. And what they do is they're a specialty ETF. They hold about 40 companies, but about 95% of them are in the financial sector. They have the highest yield in our portfolio at north of 8%. But the majority of their companies are small to mid-cap companies, and they're in the financial sector. And I think that complements our portfolio well. Plus, it drives a ton of monthly dividends. Now, I hate the fee, but I love the yield. Okay, so now here's how I would weigh each of these portfolios for our core portfolio, and then we'll look at some satellite positions. So how are we going to weigh our portfolio? So I would make SPHD the largest holding at about 30% of the portfolio because I believe that they offer the most stable monthly dividends. They're low volatility companies. They give us a dividend yield of about 4%, but I think that the reliability of those companies is a good stabilizer to make that the largest position for us. For HYLD and DIV, I would do 25% for each position. They offer awesome dividend yields near 7%, and they help with overall dividends. Then for DON and KBWD, well, they act as solid diversifiers, and I would make them 10% for each position. One focuses on financials, and the other gives us some mid-cap growth opportunities. Okay, so now we have our core holdings. What satellite positions should we add to our portfolio? We can pick individual companies, just like we did in our investment portfolio for beginners video. You can see a link in the description below. Again, you can see our Dow 30 list if you're looking for good companies that could be good ones to add, you can see that list. I've also talked about companies like Apple, AT&T, Disney. Those types of companies could be good diversifiers if you believe that there's an opportunity, maybe there's a value opportunity in one of those. Or we could stick with more ETF holdings for our satellite positions. If you prefer getting stable dividends from large cap companies, NOBL could be nice to add some stability to the portfolio. We also talked about AMLP, which is a great ETF for high dividends and exposure to the energy markets. Another interesting position to consider would be VanEck's Vector Mortgage ETF. They invest in mortgages, and Invesco's KBW Premium Yield Equity REIT ETF. They invest in actual real estate properties, and they both have dividend yields of around 7%, and they're great diversifiers to this type of core portfolio. So how do you like our core portfolio? Do you like the main holdings? Would you swap anything out for anything else? What about the satellite positions? Would you go with individual companies, or would you go with other ETFs to complement it? Let me know what ETFs you would add or what individual companies you think complement this portfolio well. Let me know what you think in the comments below. And if you haven't done so already, hit the subscribe button. Thank you for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.